So today, I'm excited to announce that the SEC is taking the most historic step yet to modernize federal securities regulations for crypto assets. It is the Commission's answer to the question that has puzzled innovators since the birth of the blockchain. How can I raise capital to develop a crypto asset while I am still working to develop the network where it will be used?
That was Paul Atkins, chairman of the U.S. Securities and Exchange Commission, or the SEC, on Tuesday, August 18th, 2026. It was from his announcement about a proposed set of rules for crypto fundraising that is about 400 pages long, 401 to be exact. The overarching goal of Reg Crypto is to create a clear, appropriate rule book for crypto projects to raise capital in the U.S. I'm smiling just thinking about that. It's progress. Thank you to everyone at the SEC for working so hard on this. And maybe you've already read all 401 pages, maybe not. Either way, you'll finish this podcast understanding everything you should know about Reg Crypto and what it means for projects and their lawyers. Let's start at 10,000 feet. What is Reg Crypto? At its core, it really does three things. It creates three things, I should say. First, it creates a pathway for projects in the US to legally raise money by selling tokens, ICOs, basically. It also creates requirements for token projects to inform token holders of developments that matter. It's a disclosure rulebook to minimize information asymmetries. It also creates, and this is the third point, it creates a formal off-ramp for a token to legally exit the expensive and risk-inducing securities laws regime once token holders no longer require the extra protection that regulators provide. So if you take nothing else away from this episode, understand those 3 points. A project can raise money by selling tokens in the US, disclose things that actually matter during the lifetime of the project, and once it's at a stage that the founding team is no longer conducting essential efforts, they step away. None of that existed before, specifically the last point, that transformation or detaching of a token from an investment contract. Now, this episode covers 3 things: why rules were needed, what the proposed rules say, and how the market could react, meaning what are the expected second-order effects or what could still be tweaked, as well as the timeline for implementation. Welcome to the Law of Code podcast. This is the show covering the legal layer of emerging tech. We cover the legal side of crypto, AI, and whatever else really matters to the future of humanity. I'm Jacob Robinson. I'm a securities regulatory lawyer turned podcaster, but don't worry, it's not just me. You'll mostly hear from the experts who are cited by the SEC throughout the footnotes of Reg Crypto. That includes Lewis Cohen of Cahill, Gordon, and Reindel, who I'm grateful to have as a sponsor of this episode, as well as Sarah Brennan of Delphi Digital, Gabe Shapiro of Metalex, Rodrigo Sierra of Cooley, Miles Jennings of A16Z, and Andrew Hinkes of Winston & Taylor. Each episode takes me a significant amount of non-billable hours to put together, which is why I'm thankful for the presenting sponsor of this episode, Altitude. They combine stablecoins, fiat, and credit cards on one payment platform that does a lot more. So if your clients use stablecoins, they should know about Altitude. Thank you, of course, to the other sponsors of this episode as well, Cahill, Gordon, and Reindel, the Solana Policy Institute, and the Hyperliquid Policy Center for supporting this podcast, because without sponsors, I wouldn't be able to justify to my wife spending my entire weekends and many evenings making these. And same goes for you for listening, so thank you. If you like to support this type of work, please share it on socials or with a friend or with an enemy. Maybe it's a good way to mend that relationship. Now, why do we need Reg Crypto? Why was this an inevitable step after the past 2 years? We'll start there after this brief legal disclaimer.
Anything mentioned in this episode by Jacob Robinson or his guests is not legal advice or investment advice. All opinions are Jacob's and his guests alone. This show is solely for information and entertainment purposes only. Jacob and his guests are not your lawyers, nor are they investment advisors.
This Reg Crypto proposal didn't come from nowhere. It's actually the most recent and most obvious step in an inevitable progression since the Trump administration took charge. This began in January of 2025 when then acting SEC Chairman Mark Ueda established the Crypto Task Force to be led by Commissioner Hester Peirce. They had a mandate to develop a comprehensive framework for crypto. 2 days later, President Trump signed an executive order titled Strengthening American Leadership in Digital Financial Technology. This created the President's Working Group on Digital Asset Markets. And that was important because that group was ordered to report back with recommendations, and they did that 6 months later. This report included a list of immediate actions that the SEC should take under the Securities Act. And these 3 recommendations will sound familiar because it's what they did. It's establish a fit-for-purpose exemption from registration for digital asset distributions, establish a time-limited safe harbor for tokens on networks that aren't yet functional or decentralized, and establish a safe harbor for airdrops. So this is a report from the President's Working Group for suggestions for the SEC. And one day after that report was published, SEC Chairman Paul Atkins announced Project Crypto. It was a commission-wide initiative to modernize the securities rules and directed his staff to develop proposals implementing these working group recommendations. Here's a clip from Chair Atkins' announcement on July 31st, 2025.
For those crypto asset transactions that are subject to these securities laws, I've asked the staff to propose purpose-fit disclosures, exemptions, and safe harbors, including for so-called initial coin offerings, airdrops, and network rewards. Regarding these sorts of transactions, our goal should be that issuers no longer exclude Americans from their distributions to avoid legal complexity and lawsuits, but instead choose to include Americans to enjoy legal certainty in an accommodating regulatory framework. It's my view that a Cambrian explosion in innovation could occur if we stay true to that course.
So in March of 2026, the SEC shared its formal view on how securities laws apply to crypto. This was along with many other announcements, statements, and guidance that they had given. This came via an interpretation that provided a foundation, really, of what came in Reg Crypto. And it identified one problem that Reg Crypto would later attempt to solve. Applying the Howey test for investment contracts to crypto assets and transactions involving crypto assets is challenging, as the SEC notes, because of the varying degrees of control that persons or groups may have over crypto systems, the diversity of the type of crypto assets that exist, as well as their characteristics, uses, and functionality, as well as the evolving nature of this technology. Now, the March release confirmed that non-security crypto assets can later be sold subject to investment contracts by looking at the representations or promises. So that's an emphasis on the marketing, which is essentially the public disclosures. What are you telling people about what you're going to do? And it aligns with what Chair Atkins said in a speech about Project Crypto in November 2025 at the Federal Reserve Bank of Philadelphia's 9th Annual FinTech Conference. Here's a clip from that. That was one big problem Reg Crypto was written to solve. Applying the Howey test for an investment contract to crypto assets and reapplying it to remove the investment contract, or rechecking to see if there still is an investment contract at a later time. In other words, this is how crypto assets became subject to and stopped being subject to securities laws, federal securities laws. The second problem Reg Crypto was written to solve is this. What happens between those 2 points when an asset is still an investment contract? So you have the distribution and then you have the scheme falling away. But in between that time, the asset is subject to securities laws, and there's a host of rules that might apply. And those rules should make sense, meaning they should cover the actual specifics of what makes crypto different from other types of assets. So if a team accepts that its token sale was a securities offering and wanted to follow securities laws, what would they comply with? That project would need to do what every other project captured by securities law does. They either register the offering with the SEC, so think the full IPO process, wildly expensive, built for companies issuing stock, or rely on an exemption from registration like private companies do. So what actually came in August of 2026? Let's walk through Reg Crypto now. There are 3 exemptions that Reg Crypto is modeled on, and these are exemptions that existed in the, we'll call traditional markets: Regulation A, Regulation Crowdfunding, and Regulation D. Regulation A is sometimes called the mini IPO. It lets companies raise up to $75 million per year from the general public using a streamlined disclosure document called an offering circular. And the SEC must approve or qualify this before any sales can happen. There's also Regulation Crowdfunding, and this lets the smallest companies raise up to $5 million per year from the general public using a file and go model where the issuer posts its disclosures and starts selling without waiting for SEC approval. Regulation D is the private placement exemption. It lets companies raise unlimited money, but generally only from accredited investors who make enough money that they can afford losing it. And securities sold under Reg D are restricted securities that can't be freely resold. Anyways, so we've got Reg A, Reg CF or Reg Crowdfunding, and Reg D. And you'll see them again throughout this episode, or at least threads of them. Like prior frameworks for certain other asset classes, including asset-backed securities, Reg Crypto is a bespoke framework tailored to crypto assets that are subject to investment contracts. Without it, as the SEC's release admits, investment options are limited for Americans who are also exposed to additional risks from participating in markets absent these investor protections that Reg Crypto includes. So this really is the SEC's way of addressing the 3 issues or 3 recommendations that the President's Working Group report highlighted. So what did the SEC actually propose? Finally, right? Let's get into the rules now. Regulation crypto assets is made up of 5 subparts. Subpart A contains the general rules, including definitions and the new disclosure playbook, which we'll get to in a minute. Subpart B is the startup exemption, and this allows raises of up to $5 million over 4 years for early stage projects. So remember, that's similar to regulation crowdfunding that we covered earlier. Subpart C is the fundraising exemption that allows raises of up to $75 million per year, modeled on Reg A. Subpart D is the investment contract safe harbor. This is the off-ramp or how you detach federal securities laws from the crypto asset. Subpart E preempts state securities registration. So these offerings and the secondary trading that follows answer to a federal rulebook, one federal rulebook, instead of 50 state ones. Without preemption, whether you could legally resell a token could depend on each state's secondary trading rules. And just a quick side note on that point, Andrew Hinkes, a partner at Winston & Taylor, is going to join to talk a lot about why that's really important later. Now, the core of Reg Crypto really is subpart B and C. It's the exemptions for projects to raise money by selling tokens. So let's start there. These 2 exemptions, one is called the Startup Exemption and the other, the Fundraising Exemption, are written for different needs, different types of projects. Startup Exemption is for an early stage of development that's limited at $5 million over 4 years. The Fundraising Exemption is for much, much larger raises, up to $75 million, as we've said. Both were written to accomplish 3 things. Number 1, provide a clear fundraising mechanism for crypto projects. 2, solve the problem of prior disclosure rules not being relevant to crypto assets. And 3, provide a method for these assets to exit securities laws when the protections are no longer needed. Here's Gabriel Shapiro. He's a longtime crypto attorney and co-founder and CEO of MetaLex.
There are kind of 3 exemptions here in a sense. One's a 5 million startup exemption, and that one is very lightweight. Like you don't have to do SEC file disclosures. You don't need the SEC to say yes to anything, right? And you still can sell to unaccredited investors. You just have to publish certain notices with the SEC and so on. So that one I think, is going to be good. And you also can stack that one with other, even though it's capped at 5 million over 4 years, which is not very much, but it's enough nowadays with AI, it's enough to bootstrap a project for sure.
Right.
And additionally, you could stack it with other exemptions. Like you could still do a Reg D private placement to VCs. right? So that one is, I'm very confident will be good and will be used. The tougher one to say is the one based on Reg A plus. I think they call it the public fundraising exemption. Because it does require GAAP financials at the higher tier, which is the tier between 20 million and 75 million. It requires that those be audited and PCAOB standardized. And so it's still a lot of Reg A plus style hoops to jump through. And, look, if you can raise 75 million from unaccredited investors, you could probably also raise 75 million from VCs, right? So you could still use a Reg D private placement, right? So I think there's some questions, and then you also have this weird thing of like, you're kind of opting into the securities laws in a specific way, and that sort of thing. So there's some question marks around how much it would be used. I think that's fair to say.
Let's start with the startup exemption. That begins at page 70 of the proposal if you're following along. Now, the goal of the startup exemption is to provide issuers with a regulatory runway, a way to fulfill representations or promises to engage in efforts that you said you would, to build your project. What type of projects will be best suited for the startup exemption? That's a question I posed to Gabriel Shapiro. He's a longtime crypto attorney and co-founder and CEO of MetaLex. He's going to explain that now.
And so this really raises the prospect that many different types of projects could use this. What really shut the ICO era down was that a bunch of centralized projects started to try to raise capital through ICOs, and the SEC didn't like that at the time. But I think that's very feasible for these exemptions, where, for example, a company like Telegram could say, hey, we're building a blockchain now in addition to our messaging app, and it's going to feature a token, and that may also have certain functions within our centralized messaging app. And, it's going to have such and such features. We're going to build it over 4 years, and we're selling a token to finance it, even though there is some centralization to it, and it's feeding into Telegram's general business capital, so to speak. That should be totally allowed, even though Telegram is not a decentralized application, right? So I think a lot of traditional projects will be tempted to use it to access additional capital. And then, of course, obviously true crypto projects are, in some sense best suited for it, because they can, in theory, become decentralized, become autonomous, or become DAO governed, or whatever it is. And so they would be able to initially have a set of promises constituting an investment contract, that they'll build certain things, that they'll do certain research and development, that they'll do certain marketing, hire certain people, whatever it is. But with the concept that those efforts may eventually end or cease to be essential after a certain time, and then it would be a decentralized autonomous system that more or less survives on its own, without the original issuer being necessary to continue that. So it's suited for a broad range, both centralized and decentralized, and I think a lot of different types of projects will use it.
There are 6 conditions to this startup exemption. Projects can raise up to $5 million. It is a one-time use, so you can't have already relied on it or re-enter it. There's that 4-year window for sales, so distributions under this exemption to occur. And that 4-year clock begins after the project files a notice. It's a simple notice of reliance form with the Securities Exchange Commission on a form called Form NOR, that you are, or the project is, relying on this exemption. And that 2-page form is very simple. It's included actually in the proposal on page 400 in Appendix F. So the exemption ends after either 4 years, or if the project no longer has any essential managerial efforts conducted, which the issuer, the project itself, would declare by filing a transition report on a form called Form TR, Transition Report, with the SEC. And the copy of that is included on page 397. This form requires projects, or this exit requires projects, to check a box certifying that they have completed or ceased all essential managerial efforts that they said they would do when distributing the crypto assets. So you either did it or you've given up, and that you will not make new promises to engage in similar efforts in the future. Now, during this 4-year period, so under the startup exemption, while you're in that 4-year window, the project must make ongoing disclosures publicly available on its website. And the SEC actually outlines what you have to disclose. And this is Rule 103 of the proposal. which includes the representations that the managing team makes that create the investment contract. So examples are given, such as a business plan containing detailed milestones, a timeline, information about personnel, sources of funding, and other resources needed to meet those milestones, and an explanation of how holders of the non-security crypto asset or of the asset will profit from the efforts of the team. You also have to disclose things like who has been allocated the tokens, how many tokens, as well as the token economics like total supply, distribution methods. There's also code-related questions like whether it is open source code or has been audited, as well as information about the team behind the project. Again, the issue, there's more there, but the issuer must make these Rule 103 disclosures publicly available free of charge on its own website and keep them updated. Now, this is a great step. I mean, this is something that we've been talking about on this podcast for about as long as the podcast has existed, the importance of having full and fair disclosures for potential buyers of crypto assets. Gabriel Shapiro of MetalX had an interesting perspective on why whether projects avail themselves of Reg Crypto might depend on necessity. Do they have a sufficient reputation that they don't need to make many public promises that people will trust them implicitly? That's something Gabe talks about here.
Yeah, well, this sort of, as you call it, marketing-based approach, was something that a lot of crypto lawyers, securities lawyers more generally, had thought about in the early days of the ICO era. That whether or not there's an investment contract should depend specifically on what has been said by the team, whether it's made any promises or assurances or representations about things that they're going to do to make the token valuable. And that if they hadn't made any of that, then there wouldn't be an investment contract and securities laws would not apply. It was generally, I'd say that approach became rejected by sort of rough social consensus of securities lawyers and crypto lawyers over time, principally because the Howey test itself and securities laws themselves in the US are not really that narrow. And, you have a case, the one that springs most to mind is the LBRY case or the LBRY case. I'm never quite sure how to pronounce it, but this was like a YouTube style video sharing web app, centralized, of course, that launched a token to have certain crypto economic incentives as part of its app, like it could pay the video posters in the token and that sort of thing. And they had been pretty they launched post 2017, I believe. So they had some of the learnings about ICOs under their belt. And they had essentially subscribed to that viewpoint that, they weren't going to promise anything. They were just going to have the token. It would be used as sort of a, just a coin within their app. And that was what they did. And when they were sued by the SEC, the judge in that case essentially took the view, especially if you read the transcripts, where he's questioning the attorneys and that sort of thing and making certain comments in the course of it, but also the opinions that judge issued. I forget the judge's name. He was basically focusing in on the mere fact of incentive alignment, the fact that this centralized team had created this token, owned so much of the supply, and also controlled an app that principally used the token for certain of its features, that alone was enough to create a reasonable expectation of profits from the efforts of that company or that team. And so, from that case and other cases, there had kind of been a rough social consensus that you could just being silent or whatever wasn't enough. This SEC is going back to that older view. But of course, since it's the SEC doing it, they do have the ability to set their own enforcement policies, so to speak, and their own interpretations of the law. And so, it means a little bit more if the SEC is saying, hey, our policy is going to be that we cabin Howey, at least in this token context, in this particular way where we don't believe that someone can reasonably expect someone's entrepreneurial efforts if they haven't promised anything, right? So they're certainly able to do that. It is a little surprising in that most securities lawyers have interpreted Howey more broadly, and some of the cases interpret Howey more broadly. So we'll see. It creates a little bit of an interesting divide, and I do think, yes, it sets a bit of a moral hazard, and it's one that especially advantages highly credentialed teams, right, or highly prestigiously backed teams, because if you have a very high reputation, like for example, if Jacob Robinson were to launch a token, well, people trust Jacob Robinson. People know a lot of code. They know you're a lawyer, and so on and so forth. And so when you launch a token, you may say nothing about what you're going to do with it, but people may be much more likely to assume, okay, a guy like this, he would never just launch a token and rug everyone. Right. So you don't have to do that. And you also don't have to promise anything, but people will still buy it. And then you're going to be outside this disclosure regime. That is the risk. I do think there are some, and a lot of people are going to end up focusing on that, I think, in their comments, especially even like maybe some people who would be considered pro crypto may say that they don't like that aspect of this proposal. On the other hand, I do think that there are countervailing incentives baked into the proposal itself, right? Like, one of them is that this doesn't, you still have to think about all the related infrastructure, right? And all the related players. There are market makers, there are centralized exchanges, there are all kinds of people that are needed for a successful token. And while this does provide exemptions for raising capital as an issuer from the public by selling a token, it doesn't address exchange liability, market maker liability, and all these sorts of things. And so what I believe will be the case is that there will be an ecosystem that uses this proposal as a Schelling point, and you will end up being disadvantaged if you're not within this structure, because people will want the disclosures, they will want the legitimacy of it having an SEC qualification, so to speak, and that sort of thing. And so I think there's going to be probably enough extrinsic pressures where probably that moral hazard will end up being a big deal, but it is a theoretical risk.
That's great. I'm really glad to hear that, Gabe. So it sounds like you're actually quite bullish on just the long-term implementation here. And that was the one thing I wanted to ask you too, is what can we learn from what happened with the ICO era of 2018? And what does that tell us about what's going to happen here? And it sounds like what you're saying is this is almost just like I don't want to say SEC condoned, but it's a legitimatized ICO era.
Yep, for sure. Yeah, I mean, there's someone, because we work with some launch pads at MetalX. And so, I've been asked by the related communities, is this bullish or bearish, right? Or even, the founders. And to me, if you're in the ICO business and ICOs have suddenly been both legitimized and legalized, I don't see how it could not but be bullish. Obviously, you may end up with some more competition because more people who are reluctant to get into a gray area may be willing to get into a black and white area. So, in that sense, maybe some individual projects could have more competition, but overall it should grow the pie massively, I would say.
So Gabe certainly is bullish, and I think that's a good thing. Ultimately, the market will decide, but this is a step in the right direction. Another important condition of the startup exemption is that each member of the project would need to sign this notice and is responsible for satisfying the conditions, including ongoing disclosures. Now, the project could be an entity, an individual, or a group of either. There are also general conditions, which are rules that apply across all of regulation crypto assets rather than being specific to the startup exemption. And the two really worth knowing are the bad actor rule, which means if your founders have securities fraud convictions or similar regulatory red flags, there's no exemption available for them. And there's a requirement that all disclosures are honest. So this is the anti-fraud provisions of securities laws, which make it illegal to lie, mislead, or omit material facts when offering or selling securities. And this applies to everything. So that's what I'll call the 6 conditions of the startup exemption. An issuer can offer, sell, or distribute crypto assets for up to 4 years, capped at $5 million total, by filing a simple notice of reliance with the SEC. This is a one-time option that requires ongoing disclosures during the 4 years. And at the end of that 4 years or earlier, projects can exit the federal securities laws by essentially ending their essential managerial efforts. Now, you might have caught the word choice there. Distribute, not necessarily sell. And that's an important theme here. The exemption covers more than just sales. The definition explicitly includes airdrops, distributions related to staking, governance, and gas fees, as well as rewards for securing the network and payments for testing. What happens if at the end of the 4 years, though, the project is still relying on the managerial efforts? You might be wondering that. That was something I was wondering at this point. Well, the project's options at that point under Reg Crypto are the fundraising exemption, which we're going to talk about in a second, Another exemption, like Reg D, full registration, or simply no longer conducting any new distributions of the assets while it finishes the work. So the safe harbor itself has no deadline, only the exemption for distributions. So let's pause for a second, step back. What's important to remember is what's underlying all this. Because retail can participate in purchasing these crypto assets that are sold or distributed under the startup exemption, there are no resale restrictions. Tokens issued this way can circulate freely from day one, which allows for network effects that are an important part of most projects. Or can they? One question becomes how these assets are treated on secondary markets. Think about things like exchanges. It was a point Lewis Cohen of Cahill brought up in our conversation.
We submitted a comment letter on behalf of one of our clients that I think points in this direction already. And that is maybe an enhancement to the safe harbor for third parties, for people that are non-affiliated entities, not the issuer themselves, investors in the issuer, insiders. And I know that the proposing release makes references to a commentary that you've had from, I think you've had Miles on the show and at A16, and he and others have felt very strongly about the concerns about asymmetries on insiders. I think we could put those, and I understand that, we put those off to one side, but people who are non-insiders but dealing with the token, I think you could enhance a safe harbor by stepping it up a further step and saying, if you fall within some objective criteria, we're not going to come back and say your transactions are securities transactions, right? The issuer may be involved in a securities transaction and may have anti-fraud obligations, may have just failure to register obligations. We have a whole panoply of obligations that arise because of that, but imposing that on the non-affiliated actors who deal with the crypto asset, I think that's where the problem. So I'd like to see the safe harbor extended in that direction. And then along those lines, clarifying in particular, I don't know if your other guests have talked about this, but clarifying exactly how secondary activity in these non-security crypto assets to which they are still covered investment contract transactions, how does that work? So I think we need to really, but I think we will. I think we'll get that. And again, I just can only say once again how much I commend and I'm grateful for the work that the commission and its staff have done here.
What you just said there is really interesting because that goes to almost the ability to make this all work, right? If you don't have secondary market trading, then it's going to be really difficult to have these rules actually benefit anyone, projects, investors, users, networks, etc.
Yeah, no, that's absolutely right. And I think there is an important distinction to be made here. And I go back often to Judge Costell's decision in Telegram, which is really in the earliest days of deciding. One of the things he kind of caught on to is the initial purchasers of the Graham token in that transaction differed from other types of initial purchasers in private placement transactions of securities. So for most securities, you might like the idea of a liquid secondary market developing, but at the end of the day, you hold an asset that has its character. It's an equity type asset and it'll appreciate in value. It's a fixed income type asset and pays floating or fixed yield to it. And there's a perfectly good economic reason to have invested your money, acquired the asset, and sit on that asset for its life. Where a token differs is that you may be an initial purchaser of an asset. It's, by definition, right, not yield bearing. That's a critical component here. It doesn't have any other character. If a secondary market does not develop, if demand does not increase, if we don't go 0 to 1 in terms of the use of that network or application, that asset has no value, right? So secondary market here is not a nice to have. It's a must have. Without it, there is no point to this whole arrangement.
Now, consensus between everyone I spoke to is that the startup exemption is a great thing for crypto and for builders. Generally, its $5 million lifetime limit is also much more limiting, obviously, than the fundraising exemption's maximum of $75 million per year. So let's talk about the fundraising exemption. That's the second big part of this. The SEC is explicit that this exemption is modeled on Regulation A, that mini IPO framework that we explained earlier, with the same dollar limits but differing requirements. Now, there's two parts or two tiers to the fundraising exemption. Tier 1 permits offerings of up to $20 million in a 12-month period. Tier 2 permits up to $75 million in a 12-month period. What separates the tiers, as you might have guessed, is compliance, or in reality, the costs associated with compliance. To get even more granular, it's probably the audit. Both tiers must include financial statements in their offering documents, but Tier 1 financial statements carry no assurance requirements, meaning no auditor has to sign off on them. Tier 2 financial statements must be audited. And if you've never paid for an audit for a crypto company, congrats. It's not cheap. It's not fun. Before we talk through the steps for a fundraising exemption, we've heard about the startup exemption being a good fit for a lot of projects, but what type of projects might use the fundraising exemption? I asked Lewis Cohen of Cahill about that. And I've spoken to some people about the startup exemption. A lot of lawyers tend to think that's where projects will go. There'll be a startup exemption and then a Reg D offering, sort of going hand in hand. What type of project could be a good fit for the fundraising exemption?
Well, I would agree with my colleagues who've given you that feedback that broadly that's the more likely of the two directions. But I do think there will be and should be fundraising exemption users. And there's a project we've been working with for some time that I think could naturally fit within that. These are projects that are already well developed, that have been very thoughtful in their approach, and that are, have a high degree of functionality already built out and are relatively speaking more mature in terms of where they're going. A lot of projects can come together fairly quickly. Some of that is spontaneity and wonderful. Some of it's a little opportunistic. Let's be honest, right? I think that the fundraising exemption, may really suit those projects that have really invested the time and the wherewithal. Many of those may have been either internally funded or self-funded or were able to achieve what they had without needing to look for other funding sources. In many cases, the paradigm we see, of course, is, somebody with wonderful ideas, but limited capital. And that's where, you kind of run into some of the issues.
How will an offering happen under the fundraising exemption? So first, the issuer would file an offering statement with the SEC on a new form, Form 1 Crypto, which is essentially a lightweight version of an IPO prospectus. Again, this was modeled on Reg A. Only in this case, it's built around Rule 103. These are the disclosure items that we covered before that are specific to crypto. And projects can choose to keep this part, at least the application, private. Now, once the statement is filed with the SEC, they review it. And that means usually a bit of back and forth until the SEC, the regulator, is willing to qualify the project's offering statement, which means staff is satisfied that the disclosure requirements are met. Now, ongoing reporting occurs after that. So once it's been qualified, you're going to enter this ongoing reporting phase, and that's a number of forms, including an annual, semi-annual, and one for material events that occur between reports. So at a high level, the three big differences between this fundraising exemption and the prior startup exemption are the limits of how much you can raise, the requirements around financial disclosures, and that projects can't sell under the fundraising exemption until the SEC gives them the green light. There's another difference, but this is more for investors than the project. If a purchaser is not an accredited investor, so if you want to buy some of these crypto assets sold under the fundraising exemption, but you're not an accredited investor, you're limited to a maximum of 10% of either your annual income or net worth, whichever is greater. And that limit applies to projects in both Tier 1 selling for 20 million and Tier 2, the 75 million. Just a side note on that annual income limit from my conversation with Gabriel Shapiro of MetalX, because I think it's interesting. I know there's also, I think it's just with the fundraising exemption, there's this income-based investment limit of about 10% of people's income. I mean, to me, that strikes me as something that could create a lot of friction. I wouldn't want to give out my income to every project I'm investing in. Do you think that's something that will be an issue?
Yeah, this is another thing that I plan to comment on, which is what are going to be the KYC AML avenues involved in this, right? Now, I think for the startup exemption, most likely that's going to be like a Reg D, so I don't expect that anything specific there would be prescribed per se. But the public fundraising exemption has to be SEC qualified, which gives them a lot of opportunities during the comment phase to sort of subtly insert KYC requirements, right? Mm-hmm. Which, like, basically the staff can, I don't know, like for people who've ever like worked with the SEC on something that needs to be approved by them, what you find is that it ends up being that there's a lot of shadow requirements that are created through course of conduct by the SEC, right? They're like, I used to run into this all the time on M&A. As a young lawyer, I was very surprised by it. They would write back when we filed something, well, do this. I'd be like, well, that's not in the rules. Like, yeah, but you have to do it anyway, right? Because they just require it. They won't approve it otherwise, right? And so there could be all kinds of extensive KYC AML requirements that get imposed through this to verify that what the person's income level is, or their net worth level. Net worth also counts for this, right? It's the 10% at the higher of their annual income or net worth, right? And so that would be a shame, because it would mean that you can't really automate a lot of this through smart contracts. And so an additional comment that I'm going to make is for them to try to introduce something that allows for ZK-based verification, like we already do for securities offerings on MetaLex. We use something called ZK Passport by the Aztec team, where basically someone can scan their passport or perhaps scan certain other information that they have, like income statements or whatever, and that just generates a proof locally that they meet that criteria, right? And then the issuer can just ingest that proof, and they don't have to personally collect and personally verify all this information every time from an individual, right?
Yeah.
So I really hope that that's it, because otherwise we're just going to be creating more and more data honeypots of people's proof of residency and proof of income and who they work for and all this stuff. And, no one wants that, right? And I think it's kind of unnecessary, but we'll see.
So it will be interesting to see how something like that is enforced. My guess is probably with this being a big win for exchanges that do KYC. Anyways, that's the fundraising exemption. There's two tiers, one that maxes out at 20 million raised and another at 75 million, both on an annual basis with varying reporting requirements and the SEC green light needed. There's also a limit on insider selling. So in the issuer's first year, existing holders can't make up more than 30% of the sales. And on an ongoing basis, affiliates are capped at $6 million in tier one total per year and 22.5 million of the tier two total. Now, most of these rules, as I've said throughout, are ported directly from Reg A, the existing mini IPO rules. The modern version of Reg A, as well as regulation crowdfunding, came from the Jobs Act of 2012. The problem with Reg A and Reg crowdfunding is that those rules haven't really worked as intended, and people instead have opted for using Reg D, which is where there's much, much less friction. Here's Sarah Brennan of Delphi Digital and the DRC to explain what happened with Reg A and the crowdfunding exemption, Reg CF.
So the Jobs Act and the crowdfunding offerings haven't been successful. Reg CF, because nobody wants that many people on their cap table. It's hard to administer. You only do that if you really couldn't raise with a Reg D. I mean, you want the least possible amount of investors to deal with, while getting the balance between offering cost and what you are able to get from the offering. Reg D is uncapped. So less friction, especially these are all early stage kind of concepts on a traditional equities arc to going public. And so they kind of scale like that. There's a lot more internal controls required of a Reg A, a lot more overhead, it's a later stage offering. And even in traditional equities, it hasn't been a successful offering instrument because of the overhead of running it. And you have significant costs that you incur and no certainty that you'll raise what you intend to. So it's very scary for, especially like on that startup arc and crypto, the arc to needing to fundraise and scale that happens prior to an initial list is like, straight up. It's very steep, very quick before you develop the types of internal controls these larger offering structures kind of make you firm up.
So as Sarah explained, the market went where friction was lowest, and that's Reg D. It's limited to accredited investors, but it's uncapped. It's far cheaper to run than Reg A, and it doesn't force you to spend months and significant money on an offering with no certainty that you'll even raise what you intended. Here's Sarah again on the costs associated with Reg A.
So like Reg A's, and I've been out of private practice for a while, let's say 150 to 200K, like pre-COVID. So like the value of a dollar has gone way down. And back in the day, Reg A on a crypto project, just trying to dupe it out, was like becoming 300 to 500K. So if we're being charitable because this is more ported and it's kind of 1-to-1 Reg A. I'd say like higher end of Reg A, maybe like probably 200. Sorry, private practice lawyers that want to charge what you want to charge, but just like looking at the scheme of things, I mean, a legal opinion's needed, which has never worked before in this space and is unlikely to. That's going to be like something that big law firms are flagging, and all the compliance stuff, and them figuring out their toolbox for the first couple. It's going to increase costs. But Reg A's aren't, like, as a baseline, a cheap, achievable offering to do like a Reg D would be.
Obviously, we don't want to see a similar thing happen with the fundraising exemption under Reg Crypto. I asked Gabe Shapiro of MetalX what he thinks will happen, whether Reg D will continue to play a big role here, and the risk that the fundraising exemption is ignored, just as Reg A has mostly been ignored by every crypto project except one, I think, that I can think of, Blockstack or Stacks, which was a Bitcoin layer 2 project. Here's Gabe.
Yeah, there is a risk. And Stacks is just a crypto example, but in some sense, it might not be super surprising that crypto companies didn't avail themselves of Reg A Plus because there were still a lot of uncertainties with that, and they had to go to a lot of time and expense for that. But even normal equity startups don't use Reg A Plus, which is more surprising, right? Which just really kind of shows it's sort of it's not different enough from the expense and time of a full IPO to be worth it. If you can do a Reg A Plus, most people are just going to wait to be able to do the full IPO, right? So it just wasn't good enough or different enough. And I think there is a risk with this as well. It is based on Reg A Plus, as I think you said, but it's a somewhat less restrictive version of that. But it still has a lot of hoops to jump through. And I think a lot of it depends on how the SEC implements this, right? Like, are they fast at it? Like, if you file for one of these, are they going to process it super quick, be super easy to work with, and quickly qualify your offering? Or are they going to drag you through the gears, for 6 to 12 months in order to get one of these things qualified? And we just don't know, right? It also probably depends on politically, like probably this SEC would go fast, right? But maybe the next SEC is less crypto friendly and they go slow. So we'll have to see how it plays out, but there's certainly potential.
One thing Gabe mentioned there that we need to highlight is Rule 101A, and that makes the exemptions non-exclusive. So a Reg D private placement to VCs can actually occur alongside the startup exemption distribution. That's within the rules. You can do both. Now, unlike the startup exemption, which has that 4-year clock, the fundraising exemption has no time limit. You can raise under it indefinitely, subject to those 12-month rolling caps. But projects would, or at least should, want to exit the expensive ongoing requirements relating to disclosure. In other words, build a business that operates as a network. And startups can exit the fundraising exemption in 2 ways. The first is borrowed from Reg A, which is that the issuer suspends reporting if its holder count falls below 300 record holders of the class. So, that's probably going to be irrelevant. The more important one is Rule 305D2, and that provides that if the issuer satisfies the Rule 400 safe harbor or the covered investment contract otherwise ceases to exist, reporting obligations terminate immediately upon filing that form we mentioned earlier, Form TR. Rule 400 is what matters here. It answers the question, how does my token stop being subject to the securities laws? This rule is the safe harbor. This is the nautical metaphor that works because it's how projects avoid a legal storm that they'd otherwise face. And 2 conditions are required for projects to exit securities laws and enter this safe harbor under the proposal. The first condition is Rule 400A. The issuer has completed or otherwise permanently ceased all the essential managerial efforts it represented or promised under the covered investment contract, and it is not making and does not intend to make any new representations or promises to engage in such efforts. So you promised to build the network, you built the network, contract fulfilled, now you publicly and permanently walk away. And that also ends the reasonable expectation of your efforts. And there's more nuance here that we're going to get to in a second. The other condition, Rule 400B, is that the issuer files a transition report, that's the Form TR, with the SEC. Now, this form requires an analysis supporting that certification that's written for a reasonable investor to understand. It's a public, on-the-record argument for why the investment contract is over. And that's an interesting point there, because instead of focusing on something like sufficient decentralization that we heard in a speech from 2018 or a lack of control, this becomes more of a contract law question. What did you promise and did you do it? So that was subpart D. That was the exit from securities laws. It's one of the most important parts of all of Reg Crypto. Importantly, the safe harbor is available to projects that rely on the startup exemption, the fundraising exemption, or, and this is an important point, neither. So yes, projects that have never complied with these exemptions, have never tried to distribute assets under these, can file one of these forms to state that they've done what they promised to get the tokens outside federal securities laws for the SEC's purposes. Now, of course, as Lewis mentions in this next clip, that is challengeable by the SEC, and it could also create issues for secondary trading. Here's Lewis.
Knowing this was coming, I wanted to bring out a particular sentence from the release on page 167. For those following along, in the middle-ish paragraph, it says, for example, if an issuer files a form TR transition and misrepresents either intentionally or otherwise that it has satisfied the conditions in Rule 400A, the Commission may take the position that, notwithstanding the issuer's attempted reliance on the investment contract safe harbor, the issuer's covered investment contract has not ceased to exist, and the reporting, registration, and other requirements of the federal securities laws continue to apply. That is completely reasonable and appropriate. I don't have any beef with that whatsoever. The concern I have is its impact on others, because the point of Form TR is not only to protect the issuer entity from knowing when they have ceased engaging in securities activity, but third parties, B and C in my example, and how they know. So if it turns out that you're for example, a dealer or a market participant or someone who might have securities law obligations, if these all were securities transactions, you see the Form TR being filed, you're like, way to go, I'm in, right? And yet, it may turn out subsequently, unbeknownst to you, that the issuer either intentionally or maybe inadvertently misrepresented. Now, all of a sudden, the Commission may take the position that the covered investment contract has not ceased to exist. How does that work? That's my concern. That's the thing Congress can address, and I'm really hopeful on September 15th, we'll see some action there. We'll find out what happens.
Yeah, the Clarity Act is reported to be voted on in September of 2026, September 15th. And for more on Clarity, listen to episode 201 of Law of Code. Lewis and many of the others in this episode join me for that as well. But we're here to cover Reg Crypto, so let's stick there. The best example of something that a project might promise to do is building a functional network or application. And the SEC is actually explicit in that if you say that you'll build a network and you do so, and you still do work to maintain or improve the function of that network, and listen closely, this is important, you're no longer conducting essential managerial efforts. I repeat, if you're doing work to maintain or improve the function of the network, you may be no longer conducting essential managerial efforts. Here's a quote from the SEC. Quote, once such network or application is functional, it is our view that services to secure, maintain, improve, or enhance such a network or application or its functionality, or to facilitate network effects, whether through sponsoring or funding development projects or other similar activities, would not constitute essential managerial efforts, unquote. That's huge, right? Because that was a big risk and a big problem that we've seen in crypto. Now, the way they did that is by basing it on promises made. Again, not something like sufficient decentralization. Here's Sarah Brennan with more on that.
The important part is the exit test is essential managerial efforts, and how you meet that is around functionality plus promises fulfilled. So like functionality, we used to think essential managerial efforts meant you had to like abandon the project not to do that. Like no one was even sure if Ethereum hit that because of upgrades and continual work. So I think that bar is very manageable, like almost, it's probably too permissive, but it should provide a lot of relief to people who have already TGE'd, because most of the markets, like, reading this, like, how does this apply to me? How does this apply to me? Do I have to do this? And they gave transitional relief through you affirmatively doing this filing and opting in and getting comfort, which is, again, the DRC framework, we specifically built that in. Like, nice to haves, really nice to haves would be post hoc sort of certainty relief on transactions up to that date from the SEC for doing it, for providing disclosures, so that you had certainty on everything up to this rulemaking, which for people who are already in the market is showing up mid-stride.
Right.
And the next thing you need is certainty that you won't go back into this regime. And that's a little less clear since the exit's so early. And I think that's something the SEC really needs to clear up over, like, ongoing support of the network. You don't have to abandon the project. That's clear from what they've said. You can do, like, ecosystem development support and funding. It's clear. If you start talking about, like, sort of material substantial network upgrades or function, I'm not sure how much leeway there is on that element.
Mhm.
You would assume there should be, because the goal is they don't want people absent, like, I had a token, I did this, and then I added a rev share on a company. You don't want people popping in and out. Like, it's not administrable. Like, if you pop in and out of the regime, like, you really want that exit to be really clean. And that was a benefit of this control test. It was very clear that you could no longer make the token and the network your alter ego. You didn't have the power. Like, you just couldn't do it anymore. And that, like, really gave a really great transition to, okay, now we're watching the secondary market to see if someone's accumulating concentration that's not this original group. The onus is now on the secondary market, and their actions might trigger something. But the development team, like, has a clear exit, and they can, like, rest easy that they're not being kind of pulled back in.
Now, Sarah mentioned a lot of great points there. And in this case, giving up unilateral control over the network or becoming sufficiently decentralized is not a necessary exit from securities laws, unless, in this case, it could be part of what the projects promise, which would then, in turn, make it a requirement for their exit from securities laws. If the project says they're going to become decentralized as part of their promise, once they fulfill that, now they arguably have fulfilled part of the promises that they've made. This legal test, as we've emphasized throughout, is about promise fulfillment. And there's pros and cons to that approach, which Rodrigo Sierra, a partner at the law firm Cooley, shares now.
So to me, I think one of the main benefits of it, and then also one of the core tensions with the approach that the SEC has taken, has to do with disclosure. I think it's clear to the staff, and it's been clear to the industry for a while, that kind of forcing crypto into the existing securities disclosures was not going to solve the issue, because they weren't surfacing the information that was important to crypto holders. So I think it's commendable that the staff, spent some time thinking about what specific disclosures are required to better inform the public. There is, however, a tension that surfaces from kind of the focus that both the March statement and Reg Crypto have on the kind of, like, promises and representations of the issuer as being the core thing that both turns a non-security crypto asset into, like, a securities transaction, and then also gives you the exit from that status. Because in practice, what I fear is that a lot of projects are going to look at that and say, oh, that's easy, then I'll make very limited promises and I'll say that they're completed, and that's that, right? So I think part of what's missing is we need to drive home the idea that, like, the promises and the representations encompass, like, all of your statements and all of your actions, not just what you end up putting in that disclosure. And I think the rule tries to get that, but we need to, I think, in order to prevent a perverse outcome, which is less, like, projects disclosing less about their managerial efforts. I think we need to have more guidance and have that concept be broad, so that we, achieve the goal of surfacing the right information. My fear is that projects will read this and say, okay, I get to escape security status once the promises that I made up front are satisfied. So therefore, I'm just going to say, like, I need to do like very basic X,
Gotcha.
Y, and Z. And then like 3
Gotcha.
months later, I can say, hey, I did it. And like, that's that, right?
Right.
And while in the background, there's a lot more stuff going on that people might, kind of be aware of, but it's not explicitly stated as part of the promises that are like disclosed up front, right?
Right.
So if the goal is to surface the right information, having the trigger to escape from security status be like the finalization of all those promises could create a perverse incentive, unless we have a pretty broad concept of what those promises are.
Not saying anything was already plaguing the crypto industry. It's what Miles Jennings of A16Z explained in an episode we did for the Clarity Act in episode 201. Here's Miles.
And I think that that's, one of the things that we've been dealing with in crypto. There's been a lack of transparency, and that was because the regulatory framework basically incentivized people to be opaque. That you can see that without clarity, that's going to continue to be the case. Even the SEC's like latest guidance on, whether or not tokens fall under securities laws is like all around whether or not the builders make certain representations to the people that are buying the tokens. And it's like, well, they're just not going to make representations then. And so like, you're just going to lead to more opacity. So it's like, it's not a problem that can just be solved, under the existing regulatory scheme. So perpetuating that lack of transparency is just something that is generally bad for the industry. And no other startup industry really has to deal with like, hey, you have to be quiet about what you're building, right? That's just like an insane prospect for trying to build an innovative sector.
Now, of course, the downside of Reg Crypto is that it could disincentivize promises and public representations by applying securities laws to them. On the other hand, it allows projects that need to make those public promises an opportunity to do so while distributing tokens and remaining on side of securities laws. So it's an incredible start. Whether projects actually use this will be determined by the market. Now, there's also a danger, though, with this approach on the secondary market, and that's something that is particularly important to crypto, as Lewis Cohen explains in this back and forth that we had here. Do you think the test here around completed or ceasing all essential managerial efforts is a workable test for crypto?
Boy, it's tough. I mean, that is, as you know, is really where I kind of have my major issues. Let me take one quick step back, right? The proposed regulation only applies to crypto assets that are not securities, but it never says when a crypto asset is a security, right? And so we've already got this layering of what about that? So I just that's an area of indeterminacy that hasn't complete, and it shouldn't go away. I'm not suggesting it should, but it's just something to bear in mind. So the March guidance steps us through 5 factors to know. So when you think about the termination of that process, you have to think about where you started from to get to where you want to end up. Now, again, the transition report is a fantastic idea. Again, I could not possibly support this more because it gives a bright line. It's just it's like a bright line with a little hole in it. It's a plane with a hole in it. There we go. And the hole, of course, is what I said before, which is subsequent change. But the factors themselves still have a level of indeterminacy. And I think for people using the startup exemption and the fundraising exemption, the regulation does a great job of saying, okay, man, sign on the dotted line. Tell us right here, what are your promises and how are you going to fulfill them? And of course, when did you fulfill them? I don't know how many people are really going to use that. And certainly the backlog of all the projects that just predate this have to be considered. So the source of the statement, the timing of the statement, the manner of communication, the specificity and actionability, the stage of the product and its functionality and how the promise got defined, just looking at my notes, all of those are relevant and appropriately relevant. Let me emphasize, no beef whatsoever with the relevance. It's just, where my beef is, to an extent I have one, is I'm fine imposing all of that indeterminacy on the person or entity that did the fundraising. Where my concern is the third parties that will, and that includes not only people who are making markets or undertaking activities, but also the exchanges, marketplaces that are dealing with these, custodians. There are a wide variety of market participants that need to know, am I engaging in securities activity or not? That's really where my concern is. And that indeterminacy, that potential for change, leaves open just a lot of questions.
And what we've seen with the Howey test is that sometimes the vagueness can be a feature, sometimes it can be a bug, and it often depends on how it's being wielded. But in this case, I think it's an important point to emphasize and to hear you talk a little bit more about how we could perhaps bridge that gap, how we can patch that hole. Is that hole patchable based on how Reg Crypto is written now?
Yeah, I think, I mean, you asked where we're going to go. So in the case of Howie, if a visitor up from the north down to Florida who gets the tour of the groves, imagine this could be yours. Don't you want to give me some money? And, I'll harvest the oranges and give you cash. There's a natural reason to hold that asset, an economic reason to hold that asset, because it is income producing, right? A crypto asset is just like the orange, but nobody was ever going to say, just give me some oranges. And that's why in intellectual modality, we came up with this idea of working with a seed of a new type of thing that's unknown to anyone, has no real value. Nobody's heard of a straw orange, right? It's the example in the article. It doesn't mean anything to anyone. There's no market for it. There's nothing. And so it's very unlike the oranges. That's why it was very frustrating to me that, I realize it's a nice little blurb, oranges are not securities. Well, of course they're not, but that's not what's going on with tokens. With tokens, we're trying to start the network effect around something that was unknown. I've got a new DApp, a new network. It's great, Jacob. You should hear all about it. But right now it's not anything yet. It's not. And so I've got to get that 0 to 1 factor, and I've got to have the secondary market to demonstrate that there is value. People need to use it. And so that really distinguishes us from the orange case and from most of the Howey literature. It's why the Howey literature really, and literature and case law, of course, really doesn't address this particular unique element of tokens, that they need to have a secondary market so that we know that people are using it.
The secondary market is so important in getting all of this to work. And a theme of Lewis's comment there is that the secondary transfers and the rights and responsibilities that come with that is something that needs to be sorted out, that isn't too clear, and the exchanges will be particularly concerned about. It's also something that Andrew Hinkes, a partner at Winston & Taylor, also flagged here.
My sense is, and it's not the exact words of the SEC, but my sense is that they would expect somebody who obtains a token on a secondary market transaction that is covered by an investment contract, that they would be entitled to rights and remedies arising under the securities laws. But that's very different than saying that they take the investment contract as if they were the counterparty to the investment contract. And I think it's a recognition of the fact that fundraising for tokens, especially in an ICO type of context, is really unique, right? Let's take Ethereum, for example. Say Ethereum was doing an offering, they would say, okay, we're going to sell these tokens and you're going to give us money, and we're going to take the money and we're going to build this world computer. And once the world computer is online, you'll be able to take the tokens and use them to buy compute cycles, right? That's basically, if you were going to try to pitch Ethereum, that's the way to say it shortly. Forgive me, Ethereum folks, if I got anything wrong, but that's my understanding of it. You could say that, there's an investment contract there, the way that I explained it. But then the real question becomes, let's say that I sell my ETH prior to the system becoming live. Do I, as a original purchaser, still have any interest in enforcing the promises that were made, independent of the fact that I have the tokens or not?
Mm-hmm.
You could say, because I don't have the tokens, then, what do I care? But there might be circumstances in which the original purchaser still does care. And that's particularly if you're giving some sort of hybrid instrument where there might be equity and tokens, or a token that pays some sort of yield, or a token that provides governance, or a token that in some contexts might provide some other rights, but might be not the full set of rights that's given to a potential purchaser of the investment contract. So that's where things get kind of funky, because at that point, there might be good arguments to say that there are two parties that should be viewed as having the investment contract in their favor. And hypothetically, you wouldn't want to see it be divested from the original purchaser. But then you end up in this really wild place where maybe Ethereum owes securities-like duties or duties arising under its context as an issuer to everyone that's ever bought an ETH or obtained an ETH, even if they don't know anything about what ETH is. They just, their friend said, hey, buy this, number go up. And those are not the sort of outcomes that are typical of the securities laws. So, I feel for the SEC. Crypto is not what they've been dealing with since the Great Depression. This is very new and very different. It presents a lot of challenges.
There's a lot of challenges, and there have been a lot of challenges in this industry, but we're making progress. And as we're progressing, it seems like we're moving away from decentralization as a core part or necessity of crypto. But that might not necessarily be the case with these rules. Here's Lewis.
I think the critical thing to bear in mind here is that decentralization needs to have a product market fit. And we see that certainly with Bitcoin. People value Bitcoin because of its foundational decentralization. People value Ethereum and the Ethereum network because of that. I think as you move down the scale, the trade-offs between usability, practicability, security, and decentralization have been a pain point. And I would love to see builders continue to work toward that and pushing decentralization, even if it's not the central securities law question. That's irrelevant, because if no people want to use the product, it doesn't matter if it's a security or not security. Like, we're missing the forest for the trees here. We want people to use this stuff and make it important to their daily lives. And to do that, decentralization is absolutely the single most important thing. And the work that people are doing to really emphasize the importance of the separation between developers and others is really critical. Developers will not come in and work and do the work we need to have decentralization if they're terrified that they're going to be prosecuted. So a shout out to all of the folks that are really doing, I would say, some of the hardest work in the space in defending decentralization. It's just that's not the securities law. The fact that it's not the securities law question doesn't mean it's not important or even more important. It's just they're two different things. And that's one of the main themes of what we talk about when we talk about tokens.
Here's Gabe Shapiro of MetalX on why that trend away from a focus on control or decentralization might change.
I mean, I think generally the current trend in crypto is toward what I would call fintechization of crypto, right? Where there are these kind of decentralization and trust mitigation and disintermediation are not currently the focus. The focus is more toward isolated areas of transparency and composability using tokens or using blockchains, and combining that with a centralized style of experience that you would get with a fintech. So I think we'll continue to see that. But I also think that decentralization will come back for a few reasons. Number one, we just happen to right now be with a very crypto-friendly administration. And so people are getting lazy and they're getting used to that climate, right? But as soon as we have a less friendly government, people start to think again, okay, how can I reduce my governmental attack surface? And that does involve, decentralization and trust mitigation, all those things. Then additionally, I think that as more and more institutions, enterprises, and all these things truly do come on chain, the more that happens, the more that actually everyone will discover that it doesn't work super well unless it is decentralized, right? Because there's just too many trust assumptions. Not everyone can just be isolated to their own permission blockchain. Not everyone, if the asset itself has all kinds of freeze functions on it, then even though theoretically it can compose, DeFi protocols are going to have to risk mitigate that someone can freeze it. So they'll never whitelist it, or they're whitelisted in some separate pools and the real composability won't be there. So in my opinion, there is just a natural trend toward reducing trust assumptions to truly get that composability. And you just can't see it right now because number one, it's new. Number two, people are just excited. Oh, something's on chain. A stock is on chain. and they don't care. They just care that it can be on chain and someone can do something with it from its wallet. They don't care that the liquidity is fragmented because there's like 1,000 different versions of it. They don't care that it can be rugged, or maybe when you go to redeem it, the redemption is not high quality, right? Because it's too exciting just that it's on chain and accessible, right? But we will see those problems play out over time, and I truly believe the best way, the whole read Nick Szabo's essay, so Bitcoin and social scalability, to me, that's one of the most important texts in all of crypto. And basically it says that the more you reduce trust assumptions, which is really done by making things peer-to-peer, the more that things scale. And so this drive towards scalability, I believe, will inevitably bring us back to decentralization, autonomy, and all those things. It's just not the current focus of the industry.
It's a really great point that Gabe made. It's the focus of the industry has changed a lot over time, and I think the concerns around legal risks are always top of mind, and this helps solve some of those. Another part that's under discussed that is equally important is state preemption. As mentioned earlier, subpart E preempts state securities registration. That means these offerings and the secondary trading answer to a federal rulebook instead of 50 state ones. I spoke with Andrew Hinkes, a partner at Winston & Taylor and an adjunct professor at NYU, about this question around state laws when it comes to contracts.
Here we have a regulator saying a transaction of a crypto asset from one user to the other drags along with it the legal rights of a party to an investment contract. That's new. That's kind of weird. It's weird for a couple reasons. Number one, there is no federal private contract law. We have federal contract law when it comes to contracting with government entities. But otherwise, contract law generally arises under a state. That's why when you look at terms of service, it usually says these terms are and your use is governed by the laws of Delaware or New York or Montana or wherever. You very rarely see federal law. And that's because we don't generally have private federal contract law unless there's a government entity involved. So that's kind of an interesting piece. But then if you think about it, an investment contract is a set of promises by an issuer to the purchaser, the investor. Those promises could be viewed as a contract. And so then you got to think about, how do I move a contract? Under most states' law, you move a contract through either a novation of the contract, which means I'm going to put Jacob's name in where Drew's name used to be, or an assignment of rights under the contract. And there are some things that are assignable and not assignable, but generally contracts get assigned all the time. The key thing is here that there is no state law that I'm aware of that says a mere token transaction accomplishes an assignment. And in fact, most assignments are accompanied by formalities. There needs to be a writing. Now, most crypto transactions are not accompanied by writings. In fact, I think there's a material amount of them that happen on decentralized exchanges where you don't really have much of a chance to even know who your counterparty is, much less document an agreement whereby you're going to be passing along to them legal rights. Another way to approach it is to think about a crypto asset like a piece of land. I can own a piece of land that abuts a river and my neighbor might be dry. And so I can enter into an agreement where I say, you know what, I'm going to give you the right to cross my land to get to the river because you got to get water and you got to fish. And that right can be attached to the land by something called a servitude. And a servitude travels with the land. That means when I transact my land to Jacob, the land is still encumbered by that servitude. So can you create servitudes on tokens? Well, if there's a state law that says so, sure. But I'm not aware of a state law that says this. So in the absence of a law that says tokens carry with them legal rights, there's a really interesting question as to whether the assumption that underlies all this regulatory language is supportable under state law, and whether, if there was litigation about this, the court would say, well, the regulatory law says that the rights travel, but state law says that it doesn't. This would be a really interesting question for a court to try to resolve.
Yeah, this would be a really interesting question for a court to try to resolve. Preemption might apply during the life of this investment contract, but what happens when the investment contract scheme no longer applies? That might leave a void that state regulators could jump into. And before we hear from Sarah, I just want to say a quick shout out to Drew for calmly putting up with my computer disconnecting every 10 minutes while we recorded. Here's 3 clips of him saying, "You're frozen," to give you an idea of what he had to put up with.
You just froze, Jacob. Still frozen, bud. Now you're frozen again, buddy.
I thought that was funny to include. Drew was being such a good sport. Really grateful for him, same with Sarah and everyone else who joined me for this. And we're not done yet. Here's Sarah on the potential risk vector when it comes to preemption and state laws.
The other concept that everyone really has wanted is this transitional relief. And this like form TR, you do not have to go through the exempt pathways to use it to get out of securities land, which is really nice, but there's no sort of amnesty, like sort of post hoc forgiveness for transactions up to that point, which is going to be part of my comment letters. And there's no certainty of state preemption once you're in that. It just says federally you're good. And that's a scary place for us to be again once we exit this framework to the extent that legislation's not passed. We do have a gap at the end of the road here. And a real weakness of this is the test to exit is permissive, where I think that you would likely constitute a security under state law under certain, like the Martin Act at that point.
So then the worry becomes that you get out of this federal regime, but you're still within the state regime.
You're still, and then the plaintiff's attorneys are coming after you is everybody's worry. Yeah.
Now, we're not done, and neither is Reg Crypto. So what comes next? As the lawyers that join me here have mentioned, they're going to be filing comment letters to share feedback with the SEC. Since this is just a proposal, none of what we've discussed is law yet. Here's what has to happen to make that occur. Comments are going to be due within 60 days of the announcement, and anyone can comment, including you. You go to sec.gov and you find the file number S7-2026-27. You tell the commission what you think. And remember, comment letters from the 2025 request are cited throughout this proposal. There are many, many questions that the SEC asks for comments on in this case, as Sarah Brennan notes here.
Yeah, I mean, so they ask 175 questions that are numbered, and there's economic analysis questions. It's very granular on, did we do this right? And what's stressful is that also invites a host of opinions, like this is crypto, we're not changing, you can tell. Every comment letter they received said something that was the exact opposite of it, or it was like left field, or I have an idea. And it doesn't feel like easy for them to get consensus on a lot of this stuff.
Here's another thing Gabriel Shapiro of MetalX might raise.
I mean, I'm really pretty happy with it overall. I think maybe the concept of, like, for example, they have these financial reporting things, but they are about the issuer's financials, like its balance sheet. And personally, I don't think that that is necessarily, if you have a project like Aave, for example, you don't really that much care. You might care a little bit about Aave, the company, but you don't have direct rights to that company. It's a labs company that supports the protocol. And there may frankly be several of those. In fact, with Aave until recently, there were 3 or 4 entities that could be relevant, right? And so what I think you would care about more is disclosures about the decentralized protocol's financial performance, financial statements for the protocol, right? And for getting more into do we have any information about the sources, like what are the quality of protocol revenues? Are there any like related deals that are potentially like artificially inflating the TVL, or that like when the deal ends or if it gets terminated or whatever would have a material adverse impact on the protocol's own financial performance. And I think that probably having a separate category of disclosures around that and almost treating the protocol as a separate entity that's as material for the token or possibly more material, and having disclosure, requirements around that, including financial statement style. Something like that could be very interesting, and it doesn't seem like that's currently reflected. This is very much it's an issuer and it's doing an offering, so of course disclose the issuer's financials, but often those are not the most relevant thing if it's a decentralized project, right?
So after these types of comment letters come in, the staff digests them, and comment period closes. The Division of Corporation Finance and the Office of the General Counsel work through them and revise the rule text and draft an adopting release that responds to the major arguments. So for a proposal of this size, that'll probably take months. After that, the commission votes on a final rule. So realistically, We're looking at a final rule sometime in 2027. But Congress is the wild card. If clarity passes while this rulemaking is pending, the SEC probably switches up the rules just to conform better to the statutes, because the two frameworks are aimed at similar problems, but in different ways. Chair Atkins addressed this sort of dynamic in his announcement video.
Now, let me be clear. The SEC continues to support congressional work on the Clarity Act, and we expect to see the bill reach the president's desk. While Congress continues its important work to advance crypto market structure legislation for the president to sign, the world and our markets keep evolving. By moving forward with our current statutory authority, we can help ensure that America remains the world's premier destination to innovate, to raise capital, and to build the next generation of financial infrastructure.
Okay, so that was a big episode. There's a lot there. Let's just do a quick recap. We've got the startup exemption for smaller projects. You file a form, you post your disclosure on your website, do your airdrops distributions legally, and raise up to $5 million across 4 years. There's the fundraising exemption for bigger projects. You file a different form with the SEC, you get that form qualified or greenlit, and you can raise up to $20 million in Tier 1 or $75 million in Tier 2 from the general public per year. In the meantime, you file ongoing disclosure reports. Now, once those projects do what they said they would, they certify that on a form and explain why. Then the token exits the federal securities laws. This is a way for the general public to buy tokens and for projects to ensure that they are on side of federal securities laws when distributing them. And remember, these were the recommendations from the President's Working Group. Establish a fit-for-purpose exemption from registration for digital asset distributions. Establish a time-limited safe harbor for tokens on networks that aren't yet functional or decentralized, and establish a safe harbor for airdrops. Now, Reg Crypto might not solve every issue in crypto, but it certainly helps us get a lot further than we've ever been. Here's Andrew Hinkes of Winston & Taylor on why this is so important.
So this is the first proactive, prospective, forward-looking thing that we've seen out of the SEC, which is a wonderful thing for the industry. Previous SEC efforts have sort of documented the significance of events that occurred in the past, have analyzed things in the context of, we believe this violated the securities laws, or have been frameworks of the type that say, if you do the following things, here's how the securities laws will view them. This is the first thing from the SEC, to my memory, that says, if you want to do a thing where you are selling crypto assets for a fundraising transaction or otherwise, here's how to do it. So this is empowering of the industry, and it signals part of the shift that we saw begin about 18 to 24 months ago when the SEC stopped enforcing against crypto and started reaching out, opening up lines of communication, embracing the industry and saying, we are going to help you facilitate transactions that you need for growth.
It's a very, very exciting time to be in crypto. Even the charts are green this week. I can't remember the last time that I've been able to say that. Thank you so much for listening. This podcast is part of my mission to help people understand the legal layer of emerging tech. And when I say help people understand, I don't mean that like I'm teaching it. It's more so just bringing together experts like everyone you heard from this podcast, like Cahill's Lewis Cohen, Delphi's Sarah Brennan, MetaLex's Gabe Shapiro, Cooley's Rodrigo Sierra, A16Z's Miles Jennings, and Winston & Taylor's Andrew Hinkes. People like that to help us all understand the rules that apply to our everyday life. Next episode will probably be on vaults. Really excited to share that. I'll also be in Washington on September 14th and 15th for the Solana Policy Institute's event. If you're in town, if you're around, it'd be a great time to organize something to see you. So let me know. If you are still listening, I highly recommend checking out altitude.xyz/law. And if you book a demo with them, they'll let me know. Hopefully I'll see you there. All right. Well, that was a lot of fun. Thank you so much for listening. Make sure you subscribe, share this with a friend or an enemy. Again, it's a good way to mend that relationship. We'll see you next time.